right. I'm Jay Taylor. I write a newsletter called Jay Taylor's Gold, Energy, and Tech Stocks. I've been around for a long, long time, as you'll see. I also host a radio show. It's on every Tuesday between 3 and 4 o'clock New York time. Some of my guests there, Pierre Lassonde has been there recently, as well as David Stockman, who is the Office of Management and Budget under Ronald Reagan. So there's a couple of my recent guests. Have a lot of interesting guests. I've titled my talk today, 2019, Which Safe Haven Markets Will Dominate? And I want to go to a little bit of history and talk about what I think is really very different this time. I think that we're heading into a period of time in which debt is starting to become a real big problem, and that the people in charge of the financial markets really don't know what to do with it. They don't know how to handle it. I'm showing a slide. This is, I was 20 years old in 1967, and there are a couple of things I like to do. I like to play baseball, and I like to do what every testosterone, what do they call us? Those guys of us that have too much, anyway, I like girls. I will confess that. It's not what you're supposed to do these days. You're supposed to like something different, but I like girls, still do, and I have my wife here to prove it. So anyway, why I'm here today, if there's, I mean, many of you can go back and probably look at some teacher you had along the way, a professor or whatever, and you can say, that person made a difference in my life. And I can say that I'm doing what I'm doing today and go back and say, well, Dr. Peyton Yoder in 1967 was a history professor at Heston College, a small college that I went to because I didn't know what else to do with my life. I wasn't a good student, but I liked to play baseball and I liked girls. And one thing, though, that stuck with me, Dr. Yoder was convinced that there was a correlation between the debasing of a currency and a nation's work ethic and its morality overall. And I thought that was a very interesting concept. If you start to cheapen your money, you start printing money like mad, it's going to have a social impact on the country. It was very, very interesting. So long about that time, of course, after World War II, the United States empire was starting to grow. Socialism, a little bit of it, Lyndon Johnson proposed, and we had this war called Vietnam. That was part of the expansion of the empire, and it was costing us a lot of money. Actually, the Vietnam War was very expensive. In 2003 dollars, it was $1 trillion. It would be more than that now in today's currency. The point is that the United States started spending money for socialism and to expand the empire, and in order to do that, it wasn't interested in telling the American people they're going to have to pay taxes for this. They just printed money. They expanded the money supply. Charles de Gaulle said, I want none of this. I don't want your dollars. Give me the real money. Give me gold. So under Bretton Woods, he was entitled to get an ounce of gold for every $35 he sent back to the US Treasury. Gold started depleting in the United States. We started losing it very rapidly. And so Nixon in 1971 said, we're not going to pay our gold anymore. We're going to default on our obligation to honor the dollar and back it by gold. So Nixon made his speech on August 15th, 1971. I remember it very well. It was going to be a temporary close of the gold window. Well, of course, the gold window is still closed since 1971. How did the United States manage to maintain a strong currency in light of the fact that it had nothing behind it any longer? Well, President Nixon sent Kissinger to Saudi Arabia, and it was arranged that the oil cartel would demand payment in dollars. In exchange, the United States would protect the family, the royal family, so they could stay in power, and that was the arrangement. Every country in the world had to go out and find dollars to buy their oil now. So we started to inflate. This shows M2, one measure of money. It shows where we were in 1971, more or less where we are now. The federal debt grew dramatically from 1971 to where we are now. Standard & Poor's, the stocks started going up. What an illusion. I mean, we think, what are stocks really worth? Well, there's plenty of money out there. It keeps bidding the price up. It has nothing to do necessarily with reality, but that's the equity market since 1971. The United States balance of trade, and this is really, I think, the most important slide maybe that I'll show you. We had to start running a chronic trade deficit in 1971. Why? Because we wanted to have the world's reserve currency so we could expand the empire, so we could engage in wars around the world, and we could just expand the empire essentially and pay for it with money that we printed out of nothing. But in order to do that, the policies had to ensure that we ran trade deficits. It wasn't an accident that we've run these trade deficits that I just showed you. The problem, in order to have enough money out there to have the reserve currency, you have to have more dollars going out than coming in. So we had to run trade deficits. And there were all kinds of policies like starting with the Marshall Plan. You had foreign aid, constant foreign aid. The United States paid for NATO. We keep troops around the world in 114 countries or something like that. We have representations almost in every country around the world. The free trade initiatives, the United States led that. But by design, it was meant that the United States would be more generous in cutting its tariffs than it would ask other countries to cut theirs. Why? Because we wanted to have a trade deficit. Not we, not those of us in middle America necessarily, but the powers that be, the military-industrial complex, the bankers and so forth, loved this policy. And so what happened was the middle class got hollowed out, essentially. The chart that you see there, it shows the U.S. labor participation rate going down, 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 and then the dotted line is the financial markets. It's the bond markets and equity markets. We see what's happened. Wall Street has gotten richer and richer at the expense of middle America. The real median household income declines dramatically over a period of time, and so what do we get? We get this guy, because he is promising the middle class that he's going to reverse these policies that I just talked about. Now, I think he wanted to, and I have to confess that I voted for him because I believed, and at least the fact that he would try to reverse some of these policies which hurt. I'm from Ohio. I saw what's happened in Ohio, in the Midwest. The people that produced manufacturing, mining, farming, things where people really produce wealth, these people have gotten hurt at the expense of the military-industrial complex and the government, essentially, which has grown dramatically as a result of it. So, but I think once Trump got into office, he realized that he wasn't really the president. I mean, he boasts a lot, he talks big, but basically he's backing down almost like every president does. So they have him now. Really, the neocons have basically, I think, cornered him, have him under control. He's got basically ready to go into a regime change in Venezuela, supposedly. He's getting back involved. He's not backing out of Syria. All these things because the establishment likes it the way it is. The problem is that you can't fool Mother Nature forever. And what's happening is that the more debt we go into, GDP is not keeping up with the debt. So the debt is starting to strangle the real economy. And this is a chart that shows the productive debt, okay, so you can look at real GDP or nominal GDP anyway, and say, okay, a certain amount of debt would boost our economy. But what we're seeing now is a huge amount of unproductive debt and even counterproductive debt. The debt is starting to weigh us down so dramatically. The Fed and the central bankers around the world are finally understanding that Keynesian economics doesn't work long term. It works very well for some people while the income, wealth is being redistributed. But so now the central banks around the world want to start to pull back QE. Eric talked about it a little this morning and speculated about how much, whether or not we wouldn't start a new QE pretty soon. And I think that's very likely that will happen. What we have, every time Wall Street starts to get hit hard, we have people like crybaby Jim Cramer. I don't know if those of you who watch CNBC, but this is a slide from 2008 when the financial market started to melt down. Cramer threw a hissy fit. I mean, he just at the top of his lungs started crying for more money. And he was just, it was really quite an event. I happened to see it on live television. So what happens then is that, you know, the Fed tends to relent and print more money. Who will buy treasuries? Here we have a problem, and I think the rest of the world is looking at this situation in the United States where we have a growing problem of insolvency, ultimately. So this is just showing who will buy treasuries and showing the holdings right now. China is in decline, declining their holdings. Japan have their own needs for financial resources. So I think at the same time there is a growing hostility towards America because of our military-industrial complex. And of course, Trump doesn't make it any easier because he's always boasting and he's, you know, what Trump is Trump. And he, you know, says nasty things to different governments and things. But underneath that, I think, is a real a real concern on the part of our closest allies even about what we're trying to force them to do. And, you know, China doesn't really like us, of course, trying to control their sea lanes. Why would they? As I say, Japan has its own issues. And NATO allies are really becoming quite upset about some things now. And much has to do with how we're trying to control the economies of Europe for our own gains. So, for example, the pipeline from Russia to Germany, Merkel is really standing against, we're trying to keep her from building that pipeline, from them using Russian gas. But also the Iranian situation, where Trump rolled back the Iranian, the agreement that President Obama had put in place. And I'm going to just, I'm not sure, okay.
The United States is going to start sanctioning our allies and their banks and their businesses because we walked away from the deal, and we're going to force them to do what we want them to do even though they agreed to the deal we came to? Are you kidding? That is a recipe quickly, my friends, for them to walk away from Ukraine, you know, where they are already very dicey and ready to say, well, we've done our bit. They were ready, in many cases, to say, well, we're the ones paying the price for your sanctions. It was Obama who went out and actually put together a sanctions regime that had an impact. I went to China. We persuaded China, don't buy more oil. We persuaded India and other countries to step back. Can you imagine trying to sanction them after persuading them to put in place sanctions to bring Iran to the negotiating table? And when they have not only come to the table, but they made a deal, we turn around and nix the deal and then tell them you're going to have to obey our rules on the sanctions anyway. That is a recipe very quickly, my friends, business people here, for the American dollar to cease to be the reserve currency of the world, which is already bubbling out there. Are you kidding me?
Okay, so this was Secretary of State Kerry, when Obama was putting in his agreement with Iran, the nuclear agreement, the neocons, the real militaristic elements in the U.S., was kicking back against that. And Kerry was advising that if you do that, you're going to have a lot of Europeans getting really angry at you, because we've asked, and we've had all these other countries, far more than the United States, sacrifice in order to get this Iranian nuclear deal through. And so Kerry was warning that there would be blowback against the United States if we did that. And then what does Trump do? Of course, Trump comes in and he rolls back, reverses the Iranian deal. So now we had a situation where recently all these European countries, along with Russia and China, are trying to find ways around the U.S. sanctions that Trump reimposed against Iran. So what I'm saying is there's a growing hostility against, it's not just against Trump, I think it's against an empire that is squeezing a lot of different countries in many different ways. I should go back to this. This is just showing the problem with the debt. The debt is growing exponentially. Now we're at the point with the, this is out of date already, $22 trillion debt. You know, a 1% increase is $220 billion more in interest expense without any benefits to the American people. And we're looking at a period of time here, and this is the Office of Management and Budget, assumes no recessions, assumes interest rates that don't do anything much more than where they are now, and showing that in the future we will, well, 2031 seems like a long ways away, but it means that interest will eat up the entire budget, interest expense. So I think that the Federal Reserve and other banks are really between a rock and a hard place now. You know, I think the Fed would like, and the other central banks would like, to normalize their balance sheets, would like to see interest rates go back up so they have some firepower the next time there's a recession. But if they do, Jim Cramer and Wall Street, and we get scared, and frankly, I think that the Fed chairman has got to be scared to death that he'll be in power when we have the next 2008, 2009 situation. So I don't know which way it goes. I mean, Eric was talking about watching the Fed, watching what's going on. Very important now. But if they keep kicking the can down the road, the rock keeps rolling down the road, eventually we get into a hyperinflationary situation. That is very, very possibly true. Donnell DiMartino Booth, who was an assistant to one of the Federal Reserve to Richard Fisher, who is at the Fed, and I have her on my radio show sometimes. She was really a big backer of the current chairman, but I guess recently she was disappointed. I thought that when he sort of recanted or relented in quantitative tightening, or at least verbally he did, and the markets responded. The equity markets went up, and Jim Cramer was happy again. But the point is that it's really a very difficult. It's a no-win situation for the central banks, but they put themselves in this position by this enormous amount of debt that they've loaded on us. I put together something that I try to watch. I do it every week. It's my inflation-deflation watch. I can't tell you all that's in there. I don't have the time, but it's equities, it's commodities, and debt. And I'm really trying to see, are we inflating or are we deflating? Is the system going to implode? Is the rock going to run over us? I mean, are we going to, rock going to come on top of us, or are we going to just keep inflating, kicking the can down the road? So far, 2008, 2009 scared the devil out of everybody. And it scared the heck out of the Fed. And so, and here we see as soon as people start crying a little bit about the equity market, immediately you have the Fed relenting. So the big question in my mind is, which way do we go this year? Does the dollar retain its strength? And if we go into the deflationary direction, I would say yes, it will. But if if the Federal Reserve Chairman and other banks around the world keep printing and printing and printing, there could be, and there's signs already, I believe, that a lot of the really smart money is starting to doubt the legitimacy of the dollar long term and starting to buy some gold and build up their assets that way. I have looked at several times since 1971 when we've seen money come out of both stocks and bonds, and these are the periods of time, and it's always, except with one exception, always very bullish for gold. The exception was in 1981 when Paul Volcker allowed interest rates to go to double digits. And then gold was hit really hard, and we had a period of time in which the dollar had some legitimacy, it had some strength, and we had a bull market. We had a good time since then. But I don't see how in the world anything like that could happen again at this point in time. There's no way. My first mortgage was a 17.5% mortgage in 1981. There's no way that we can go to 10, 12% on the treasuries now. I mean, we're having 4% is challenging the markets now. This is the gold price, and this doesn't look like a market that's ready to go into a bear market for me. It looks very bullish. I'm not a technician, but it looks pretty good. But I rely very heavily on a technical analyst named Michael Oliver, and I have him on my radio show almost every week because I really gained a lot of confidence in his work. It's a momentum orientation, and you'll see the green line there. He's not worried about gold. Gold has come down a lot. A lot of the price chart guys are really, they get nervous as soon as gold has some weakness. He's convinced because of the momentum and the structure has been broken on the upside, or been taken out on the upside, that he believes, he thinks the bull market is a foregone conclusion, and that we're looking at something. He thinks the first stop in the bull market, the first major stop, will be around 1700. So we see whatever happens will happen. But what will happen now is we're going to have the people that can make use of money here. I'd like to think I could too with my newsletter, but these are the people I write about. These are the people that I've invited to this show. Riverside Resources is a prospect generator that I've been following for almost since its inception. It hasn't really excited me yet, but I think John Mark Stouty is going to give us some reasons to be hopeful this year, maybe, John? And we have a Coral Gold Corp, which is Louis Wolfen, who's passed away, a man I knew when I first started writing my newsletter. Coral Gold had some success and had actually done some economics on an open pit project, but now they've turned into a royalty company, and Barrick Gold is working on their project, on the Robertson project, and we'll hear from Luke. He's going to tell you the story in a few minutes about that. But that stock is selling at cash right now. And Barrick, when I think it comes out with some economic news, I think the stock could rise very dramatically. Novo Resources, of course, is probably a name that you're all familiar with. And Quinton Henning will give us the latest on what's happening there. It's just a very, very interesting story, one of the most unusual discoveries ever, I think, and it brings with it its challenges, but Quentin Henning, I think, is up to the task, and he is a creative thinker who's finding some very ingenious ways of tackling the challenges. Fremont Gold, one of my newest recommendations, and they are in a couple of the major gold belts in Nevada, doing a nice job, and they have, I think, a good chance for success this year with their drill program. Rise Gold Corp is a real new addition to my list as well. And Rise Gold Corp, they have the Idaho Maryland mine that was one of the richest, largest producers in the United States. It was shut down in World War II. M Gold had it for a little bit and didn't really make much of it, but nobody drilled this extremely rich deposit below the old workings until now. And the vertical extent is tripled or quadrupled, and with the same kind of grades. It's a very exciting story, and we'll hear about that in a minute or two. And then Newrange Gold is going to be tomorrow. I've invited them here. Greg McCoach will be with Newrange tomorrow, but it's a story I like a lot in the Walker Lane, the northern end of the Walker Lane trend. With Bob Archer recently joined the Robert Carrington story, I think, has good exploration potential this year. And then Klondike Gold Corp, really looking at, for the first time, a systematic exploration of the source of the Klondike placer gold, a very major placer discovery, but for the first time using real modern-day scientific exploration methods. They are finding the host rock, the original source for the placer gold. Well, that really wraps up my time. I've actually taken 2 minutes of someone else's time. Thank you very much for your attention. And it's jtaylormedia.com for my radio show, and you can listen to it the following day if you can't listen to it live. Thank you very much.